Good morning. My name is Frank Grinnell. I've been advising professional money managers and investing in the stock market for over 20 years. It serves as my day job, but most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we actively manage dynamic stock and ETF models for financial professionals and their clients, as well as individual investors. If you want to learn more about what we do, send me a note, frank@grinnellcapital.com. You can also find more of my insights on Twitter @GrinnellFrank. And now, today's Street Views. Hey, good morning. It's Wednesday, 24th of August, 2022. Kind of quiet out there. Equity futures pretty flat. Energy commodities are up just a touch. Ag commodities are up a little bit more. Rates up quite a bit across the curve again. So you got the 10-year, I think 305 is the current yield there. Jackson Hole on Friday. Feels like Powell needs to speak pretty hawkish, like you've probably heard from a lot of people. Given the rebound the market's had since the last rate hike. But you never know. I think that's why things are just so quiet out there. Everyone's just hanging on this Fed Powell's commentary on Friday to see what that looks like. So with that being said, it feels like everyone has gone kind of max bearish again all of a sudden. We had that big rally, and now all of a sudden we faded after hitting our head on the 200-day moving average on the S&P, and now it feels like everybody's just all bared up, and I don't know if that's, you never short a dull tape is what they say, right? But hedge fund data does show shorts are still out there in great numbers. I don't think it makes a lot of sense to get completely on one side of the boat. So we've got our long vol, we've got our inverse ETFs to help protect us a little bit. I don't like having a long vol, I'll be honest. It has had a big move for 2 days and just kind of bleeds lower. So I don't know. It's just something doesn't feel, something's not totally adding up. You look at the ags, they've had a pretty good recovery. If you look at wheat and corn pricing in the commodity land, they come back a little bit from the lows. Droughts widespread. Everybody kind of knows that. Fertilizer names in particular have rebounded quite a bit, and I think are still compelling. If you look at something like a Mosaic, which we own, Mosaic, there's CF and there's Nutrien, NTR, kind of the three big ones out there. I think valuation is still reasonable on all of them. Mosaic in particular, 4 times forward earnings. It's like a mid-teens free cash flow yielding name. I just think there's secular trends there are pretty strong. I think a lot of it you could even extrapolate that out a little bit further and take a look at ADM. That stock's had a nice rebound from the lows. We talked about Deere, great quarters, great backlog. All the strength seen in the crop markets is obviously helping farmers afford more machinery and what have you. So Deere continues to look interesting too in terms of machinery. All those names I think are compelling on pullbacks. You look at pharma. There was some selling yesterday throughout the healthcare space. Not totally sure what that was about, but they seem like they have these days where they just take them down for a day or two. I think it's freeing up cash on winners, attempting to redeploy, and losers kind of thing is the only thing I can really think that makes sense. A little sector rotation. But I still think those go higher. I think Lilly does eventually see new all-time highs. Vertex might break out firmly above 300 at some point. Merck looks great. I'm less bullish on med device. Medtronic, very punkish, sleepy quarter, pretty crappy. They got a downgrade today from one of the sell-side firms. It just looks like the availability of equipment is still not there. Supply chains, they're still having difficulties. It just seems kind of pathetic. I don't know. These things can't get out of their own way. All of a sudden, they just act like crap. So I very, very well may eliminate that IHI. I had that IHI ETF, which I had like a 5% gain. Now it's like flat. Just not impressive. The thesis behind it, seeing more surgeries, you got less COVID folks taking up ICU beds and what have you. elective surgeries on the comeback, but it's just not happening. Maybe not yet. Even Intuitive Surgical, we own that one as well, and that one just kind of starting to languish as well. I might just lose them all. And that's all I got. Have an awesome Wednesday. NVIDIA tonight. Don't forget that one. Everyone's all bared up on that one, I'm sure, which seems like it makes sense, but you never know until the report comes out. Have an awesome day.
And now for some important disclosures. Grinnell Capital is a state-registered investment advisor. Services offered by Grinnell Capital can only be offered in certain states where Grinnell Capital is registered or meets required exemptions. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisorinfo.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be construed at the provision of personalized advice and is subject to change without notice. This material should not be considered as a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility therefore. This podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve strong relative and risk-adjusted returns, primarily by investing and trading in securities issued by companies that focus on the global information, technology, consumer, healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth, an abundance of both new and maturing product cycles, a high degree of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization, and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange-traded fund, ETF, strategy with investment objectives similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some downside protection in the event of significant market stress through investments in ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, grinnellcapital.com.